Welcome to this panel session this afternoon. I'm Andrew Taylor, I'm Head of Leisure at NatWest, and we're going to be looking this afternoon at sort of funding, but from a slightly different angle, from the perspective of what other sources of funding there are out there besides traditional bank debt. So looking at challenger banks, looking at niche funders, and really just having a bit of a debate about what that means for owners and operators. So I'm joined on panel today by Andy Lancaster, who's Head of Corporate Hotels at RBS. Mark Davies, who's Head of Specialist Sectors at Metro Bank, Bettina Graf Parker, who's Head of Hotels at Ariel Bank, and Charles Scudamore, who is from Heatherley Capital, an owner and an operator. So I think we'll probably just start by just giving everyone an opportunity to introduce themselves and say a little bit more about their organisation and their role. Mark, would you like to kick off?
I might just wait for the door to shut, no? Hi. So I'm from Metro Bank, which is the so-called challenger bank on the panel. Actually, we see ourselves as a full-service bank and probably therefore the only true challenger in that we are across retail, commercial and private banking. We're actually the first license to be the first banking license to be issued for over 100 years, brand new banking license. The whole model of Metro is a service and convenience model, and we are trying to make all of our customers fans of Metro as we go forward.
Hi, I'm Charles Scudamore, Heatherley Capital Partners, kind of principal and founder of the company. Set it up 3.5 years ago now. Started with acquiring limited service branded hotels, Holiday Inn Express hotels in the UK. Followed up with a couple of IBIS hotels with Accor, and we've recently purchased a fuller service 4-star hotel in Scotland at the back end of last year. So kind of extended what the strategy was, which was identify, acquire and improve the performance of underperforming, undervalued hotels. And we've taken that next step, which is getting involved in a fuller service 4-star hotel in Scotland. Going forward, we work with a range of high net worth individuals that invest in the structures that are put together. We deliver decent returns back to those investors, recycling some of that cash into new deals, and also working with JV partners and institutional investors to grow the business and grow the portfolio.
My name is Bettina Graf Parker. I am the head of hotels at Ariel Bank, we have always defined ourselves as a niche lender because we purely are commercial real estate lenders. We don't do retail banking and we don't do investment banking, but we do commercial real estate lending and we do it really well, and we also do hotel lending really well. We have an allocation of roughly 25% of our complete balance sheet is in hotel loans, roughly 5.5 billion of hotel loans. Those are in Europe, North America, and in Asia. And our target markets are 4 to 5 star hotels in key city center locations. What we're also very good at is cross-border portfolios, because we cover a very large spread of countries and are very good at that. And it's hard to say what we are. Are we a traditional bank? Yes, because we have been doing what we have been doing for a while. But are we a niche bank? Yes, as well, because we're so focused on commercial real estate and hotels. So I hope that adds to it.
Okay, and finally, I'm Andy Lancaster at RBS. I guess RBS is probably fairly well known to many people in the room. You've probably read lots about the institution over recent years. In terms of RBS and our strategy today, we are focused on the UK primarily. We are active selectively outside of the UK, but our primary focus is working within the UK. I look at the hotel sector exclusively, and that will range from individual assets in regional UK to large portfolio acquisitions that have taken place in recent years. We will look at development finance, investment financing, CapEx facilities, and across the range. And unlike some of the other lenders here. We are a retail bank, so we are doing day-to-day cash management and traditional banking product as well as lending money.
Okay, thank you guys for the introductions. I suppose a good starting point, and I think I'll probably look to Charles as an owner and an operator, is sort of how are you finding availability of debt in the marketplace generally? How easy is it to come by, and what are the differing terms available to you?
Yeah, I mean, we started the business, as I said, 3.5 years ago. So, I mean, pretty challenging economic times, back then. And our first deal, which the Holiday Express in Dundee, was done kind of late 2012, early 2013. I've never had a problem with obtaining debt. But it's debt on reasonable terms, so it's debt with probably five, 6 times current earnings. Nothing ever more than that. Interest rates sub 3%, so it's relatively cheap debt. We've got 5-year terms, 20-year commits. No sorts of issues with the broad structure of the debt available in the market. We have got a couple of really good relationships with a couple of the UK high street banks, and NatWest being the primary source of our debt for our deals. We've got a good relationship, but that relationship is built on, previous to Heatherly and setting up that business, was 10 years in the advisory side of the business, which is understanding kind of UK provincial city markets, what works, what doesn't work, market positions, price positions within those hotels. So we have hopefully as good a understanding of some of those city markets in the UK as anybody else, and we would never put anything to the bank that we feel that was stretching the envelope. And so kind of the quid pro quo to that is that we get terms from them which are reasonable. The value upside that we have, which is looking to improve the operating profitability of any hotel that we acquire, means that we're massively obviously incentivized to improve that profit position. Otherwise, that capital upside is not there. And we put together quite a detailed DD pack to the bank every single time we put together a proposal to them. And so far, it's 100% success rate with credit. So that in itself, hopefully, is a sign of where we are and how we view our relationship with our bank. But debt has never been a problem.
Do you feel there's more availability of credits across the spectrum at the moment in terms of sort of different classes of lender?
Yeah, I think there is. It's difficult for us to see past a traditional source of debt funding because we have that strong credit line. So, if you have that strong credit line with an existing high street bank, why would you look at other opportunities when, given the cost of capital coming out of that bank, it is cheap. So we prefer to enhance or I suppose reinforce the existing good relationship we have with our existing bank, as opposed to trying to pimp ourselves out to a whole range of banks to see if we can get a better deal with someone else.
Okay. And I think one of the things that we see in the market at the moment is that different lenders have different sort of areas they want to work in, and perhaps that's something we can explore over this session. Perhaps to start with Mark, in terms of what sort of transactions does Metro Bank want to do versus those that it sort of doesn't want to do?
Yeah, so our lending to hotels is only really 3.5 years old. In fact, our commercial banking division, if you like, is only 3.5 years old. Metro is only 5.5 years old itself. So the types of deals that we do tend to be on the smaller end, and therefore restricts the type of deals that we can do in terms of portfolios, in terms of the larger assets. So our kind of sweet spot, if you like, in terms of deal size is somewhere between 2.5 and 10. But interestingly, somebody said to me yesterday at the conference, I understand your maximum lend now is £10 million. And I said, well, that's because you asked me that this time last year. And it's now £20 million is our maximum that we'll go to. I'm further a little bit restricted by geography as well. We only do UK. In fact, we tend to only do the south of England. Having said that, we will look wider for our existing customers if they're looking to invest across the rest of the UK as well. And the final thing that I would say is from a Metro Bank perspective, it's all about, our business was founded by an entrepreneur, not a banker. So we are very much an entrepreneur's bank, and we'll spend a lot of time talking to our customers and understanding what their strategy is and their experience, as opposed to necessarily concentrating on the asset itself, the hotel. Yeah.
And are you looking at portfolios or just single assets?
I think that the debt size kind of restricts us a little bit. Maybe a small portfolio when there's just one, 2 or 3 hotels, but we can't do anything more because of the debt restriction, if you like. Our largest lend for an existing customer is only just over 20, and that's from a customer that's joined us right from the start as well.
Okay, thank you. Maybe if I can ask Bettina to comment similarly.
We focus on, as I said, 4 or 5-star hotels, so there is a little bit of a different sizing here. We also do not only focus on the UK, we do Europe, entire Europe, we do North America, and we do Asia. Our focus is on Europe. We have our minimum loan sizes are probably around the 30 million euros, and we like to say we have no upper limit, because we do a very strong in portfolios. So I think our largest loan is probably in the area of 300 million pounds with for 2 assets, that would be. So that's pretty sizable, and that is also quite rare, because generally we don't want to put more than 100 million euros on one single asset. I think that's in terms of spreading your risk, we are a small bank, so that's how where we have our comfort zone. Yeah, I think what we don't do is construction, because we have, or development loans, because we have a refinancing system. Some of you may be familiar with the German covered bonds, the Pfandbrief, and we can't, for us it really doesn't make sense from a refinancing perspective to do development loans. Also, being located in Wiesbaden, close to Frankfurt in Germany, it's very hard for us to monitor development loans in, let's say, Spain, because we have a wider geographical reach. We don't want to get involved into development loans. So it's predominantly acquisition financing, renovation financing, rebranding, and general standard refinancings.
Okay, and I think if you're looking across the panel, it's probably Ariel that is most active internationally. What countries are you in and not in terms of hotel finance?
As I said, we have this 3-continent strategy where we say we are active in Europe. In Europe, I think we don't, and have never done, even prior to the crisis, we don't do Greece, we don't do Portugal. We're now not very strong in Eastern Europe, which we used to be. Prague was one of our very strong markets, but obviously it was a very strong focus for a lot of people, and we therefore haven't invested in Prague or in the Czech Republic in the hotel sector for a very long time. Obviously every country in Central Europe and Scandinavia, so that's sort of our focus in Europe. I would say that the strongest markets for investment are in Europe, probably London, Paris, and Amsterdam. Then in the US, pretty much, also the big gateway cities. We have some secondary cities that we would invest in, because we know they're good hotel markets. We're also strong in Canada, which is something that is we like very much, because Canada, in comparison to the US, is a lot less volatile. Like, they don't grow as quickly and as fast as the US will, but in a downturn they will also not go down that much. So it's a little bit more similar to, I would say, Europe. And so we like, it's a smaller hotel market, and there's not that many opportunities, but we like doing business there, and we probably have a portfolio of probably 300-400 million there. And Asia is very limited for us on the hotel side, not for the bank, but on the hotel side, because we find that as we don't do development, there's still a lot of development that's ongoing, and we also find that the people that invest in Asia are very reliant on their corporate banking relationships, just similar as here they have corporate credit lines that they use for their hotel investment. And we also find that it is a little difficult to, from a cultural perspective, to do business because the people over there like to work with their local banking relationships.
And Andy?
So from an RBS perspective, so we are UK focused, as I sort of outlined in the introduction. We enjoy and continue to enjoy the largest market share across the mid-market corporate space in the UK. So by virtue of that, we do see a lot of volume of traffic that comes through us. And that will range from individual hotel assets in regional UK where the borrowing is less than £1 million, through to some of the portfolio transactions that have happened in the UK in recent years, where we've had North American PE acquiring regional portfolios in the UK, and we have a business model that enables us to play in all of those areas. Development finance actually is something that we do quite a lot of, and across the UK at any given time, and currently we have schemes ranging from branded assets across the country generally, through to overseas investors and brands that are coming into the UK for the first time, and we're financing some transactions in London for people like that. I think, so across the range, we're lending across pretty much every spectrum of the hotel sector. I think that the glue that will knit it all together for us, because I guess the question is, what do we focus on when we're looking at a lending proposition, and I guess why is Charles so successful at his 100% strike rate of getting every deal through his bank? A banker's looking at ultimately sustainable earnings. What can we look to now and in the future for this particular hotel asset or this portfolio, and we work our structures around that. So underpinning that, there is clearly a lot of components that will give you certainty around the future of those earnings, around brand and location and management teams and operating model, and a whole load of other things. But that's really our focus, is underpinning that earnings. And if we can do that, then we're happy to look at development finance, investment loans, CapEx funding across the range, really.
And just touching on that sort of development piece, because I think we're probably the main bank that does look at that across the panel. What are you seeing in the development arena at the moment? Has much changed over the last couple of years in terms of demand for development loans?
Well, I guess what we're seeing, I mean, it's an exciting time. There's a lot of innovation, I think, in hotel development in the UK, focused around the major cities. But we wouldn't have to go back too many years at this type of panel to talk about London as being a traditional London hotel market, so Mayfair and the traditional markets that you'll be familiar with. But more of our inquiries and activity around development finance, partly driven by availability and cost of sites, has been around New London, so Shoreditch, King's Cross, Stratford, areas that weren't traditional hotel markets. And those markets are slightly different to core London or traditional London, and so they lend themselves to more innovation. So some of the schemes that we are involved in and some of the schemes that we're not involved in around those markets are actually different hotel product that's coming to market. So they're slightly more boutique than some of the traditional core brands that are in traditional London. They're offering something slightly different. And so I think it's an interesting time for people who are experiencing hotel product in London. There is huge liquidity around the hotel sector, I guess globally, but London particularly, I've probably never experienced more lenders trying to place money in the hotel sector than there are currently. But helpfully for us, not everyone is so focused on development finance, because they are inherently carrying more risk ultimately, because you're buying into the future earnings of an asset that doesn't currently exist today. So by definition, there is more assessment and rigour that should go around an advance to development finance. So we're maybe not seeing as much competition for development finance, but there clearly are more people than RBS doing it. But actually, it's a very rewarding part of the job, because you're generally working with a partner from a vision through to a trading asset that will appear at some point in the future. So it's a fun part of the role.
Okay. And Bettina, in terms of deal structuring at the moment, do you want to talk a little bit about how Ariel approaches structuring deals and what the sort of mechanics of that tend to look like?
In terms of structuring the loan size?
Yes.
Yeah, obviously we're looking at, for us the income is very important as we are not a development lender, so we're mainly focusing on the existing income of the hotel itself. We have a hotel team that completely understands, the ups and the downs of the hotel industry, which I think is very important because in comparison to other asset classes in real estate, we most often don't have leases, and if we have leases, they're flexible leases, so the income can go down, up and down very quickly. If there's a downturn or recession, then the income is directly affected, rather than in a office loan where I have a 10-year lease with PwC, and there's no issue with that, even if there is a downturn. So we look at it from a perspective of more of a business finance, and so we underwrite the cash flow of the property. We look at the fluctuation of the property, and we define a normalized year that we would say is, reflective of the sustainable performance of the property. And then we probably, depending on where we are, lend on a yield on debt of anywhere in between 7 to 8%. 7% is something that is probably for an asset that has recently undergone a significant renovation, where we can completely underwrite the upscale of it. And sometimes that takes the borrower to the loan amount they would like to see and they need, and sometimes it doesn't. And if it doesn't, then we also obviously work with mezzanine lenders, which are around and are often used to structure these kind of deals, which we don't have anybody on the panel. But what we see there is that the mezzanine lenders are often willing to go up to an amount of, 5 to 7% yield on debt, and then again, it depends on the location of the asset, on the history of the asset. I mean, I would say 5 times is a very aggressive loan, and there would need to be a big story behind that. But often that, in the end, then ranges for us as a senior lender in the 60% loan-to-value range, for the mezz 60 to 65, and for the mezz lender up to 75. That's something that we feel comfortable with. We see deals being underwritten much more aggressively, but that's then not our cup of tea, and that may be things that other people are doing.
Okay.
It's an interesting point, because I guess everyone on this panel and at this conference is here because we are specialist hotel sector lending teams, and therefore we delve into the operating model of a hotel. But I talk to borrowers sometimes who say that's very interesting and it's fascinating to talk to you, but there are lenders out there who are not hotel sector experts. They are more commercial real estate lenders, and they're very happy to give me 65% loan to value without really delving into the details. So that's a risk, I think, to all of us. That's competition that we're seeing in the market, because depending on which market you're in, there can be a meaningful disconnect between underlying earnings and asset value. And so if someone is focused purely on asset value, they're probably going to get to a different number than we are.
But I think that those ultimately are the lenders that, particularly in hotels, you always see, I think you can define the cycle or where we are in the cycle by the amount of, or the number of hotel lenders that are in the market. Because there is, very quickly when there is a downturn, just because hotels are affected so much, a lot of lenders withdraw very quickly from hotel lending. And as the cycle moves on and spreads and other asset classes are getting lower, people go like, oh, let's think about hotels again. Perhaps that's where we can get margin again. We have been around for a while to see them coming and going back and going out, but ultimately I think the kind of people that come in now and say, I only lend on value and who cares about the sustainability of the cash flow and the serviceability of the debt, I think those are the financings that will run into issues first, and that's also where you then have an unknowledgeable lender that doesn't know how to support you through such a downturn.
Well, I guess that ultimately that is the acid test for a borrower, is how does my lender react in the event that something happens in the market that causes my business plan to not follow the path that we were brought into. What happens in those circumstances? And I think well, certainly we will. I know, everyone on this panel would say that in those circumstances we understand the sector sufficiently well that we would work through those scenarios with our clients, and our financings are constructed in such a way that we can accommodate some of those shocks to the sector.
And on that structuring point, I mean, in terms of the absolute level of debt available, Charles, how do you find, are you able to get to the level that you want for your deals? Is there that gap that requires sort of a mezzanine tranche, or how's that experience for you as somebody owning hotels?
Yeah, I mean, I think it's become increasingly difficult in the last kind of 12 to 18 months. I mean, I think certainly in the UK, you see kind of very punchy prices on some pretty secondary hotels and tertiary locations, which actually you look at and you go, there's no way you can get to actually what the agents are asking for in terms of the guide. So you don't even necessarily waste too much time. It's those hotels which, I mean, particularly hotels which are eminently brandable in city markets in the kind of 25 UK kind of city locations that we all probably know of. There is a lot of competition for those assets, and I guess the thing that we try to do is to stick to the principles of understanding the market in which those hotels operate. So if you're pushing it too far and you're having to convince yourself along the way that you can change things within your model to make it work, it's that kind of cold towel on the forehead situation, which is this actually achievable, or am I just convincing myself in order to do the deal? And there's been a couple of occasions where you probably have that kind of moment where you go, we are pushing it too far here, and you step away from the process and you let someone else do it, and you kind of, good luck to them. But there's quite a lot of examples in the market, I would say, of some very, very punchy pricing on, as I said, pretty mediocre stock in pretty tertiary locations. But that's not to say, I mean, I'm not party to those deals, so they may well see something which I don't. But fundamentally, it's understanding the market in which those hotels operate. And instinctively, you look at some stuff and just go, not for us.
I'm guessing that's probably not how the agents describe it in their marketing brochures.
Yeah.
They've got some secondary stock, isn't it?
That's not how they describe it, but it's one of those warning signs when you see forecast projections in an agent's IM. You know that you're probably paying, a little bit over the odds. But look, I mean, we just don't go in for that, because as a growing business, the one thing that we need to absolutely stick to is the integrity in terms of the kind of buying process that we go through, and obviously our responsibilities back to ourselves and our investors, because we don't have an ability to make a single mistake. So we will not go there.
And Mark, finally, just on the longevity point. So you've got a strong background in the hotel sector, but Metro is very new to the sector, and you describe your customers as fans. I'm just interested. So this is a long-term strategy for Metro?
Yeah, very much so. Yeah, and our view is very much to look at our customers and structure our deals around our customers. So, we'll take a very long-term view to build up a relationship over a number of years, but make sure that we're clear with, for instance, where we can get to on debt size, as an example, and say that, we can't do any more than X, so you will need to bring in other lenders above that number. But we're very much going to support you, with your plans, and we will stretch the boundaries. So somebody asked me when I first joined Metro, are you going to write the hotel policy for Metro? And I said, why would I do that? Why would I restrict myself by the hotel policy that I've written? So Metro has an overarching credit policy that every bank has to submit to the FCA, but I have no other guidelines apart from that we want to make sure that we have very low bad debt rates. So hence, we look very, very closely at the people. And it was only at lunchtime today, somebody was talking to me about I had an underperforming hotel, and I changed the general manager, and the sales are up 46%. And we all know that if you get the right management in, from ownership all the way through to general manager and everything else. So we take a lot of time to understand the structure of our customers and what ability their management team have to deliver. So very much in there for the long game, and growing our book in line with the size of the Metro book as it grows.
So you think that gives you more flexibility to create some unique structures on occasion as the client need arises?
Yeah, and we have done that, yeah. And we're not afraid for MES providers to come in as well. If we get to a number and we can't do any more than that, and the MES can come in and take a little bit more risk as well on an intercreditor. So it's not like that's all we do is real vanilla stuff and that's it, just because it's smaller debt sizes. But we will absolutely stretch the boundaries. You know, LTV doesn't really come into it. You know, we're looking very much as the primary source of repayment is that management team delivering.
Okay, thank you.
I think that one of the sort of primary points, and what we in our wider hotel team spend a lot of time doing at the start of any deal, is making sure we truly understand what is the motivation of the borrower. What do they really want to achieve? Because not every borrower wants to take maximum leverage. Some people are happy to take a slightly more conservative structure, but pricing is very much the focus, or there needs to be flexibility around free cash flow and what can and can't be distributed, structures that enable an exit at a certain point in the future. So there's going to be very different motivations between a family-owned business where all of the focus is going to be around the future of this business because it's going to pass through generations versus some of the financial buyers who've been entering the UK hotel market who have very defined strategies as to what they want to achieve within very defined timelines. And there's different lending structures that play better to some of those borrowers than they do to others. So there is a risk that, you know, to Mark's point, if we craft an overarching policy that defines, you know, a cookie cutter approach to lending to the hotel sector, that we're going to deliver something maybe that doesn't fit any of those borrowers. So we have to start with the question, what is it that you would like to achieve from your lender? And that's a good question to ask.
Yeah, and I think that's absolutely true. You know, you have to look at, you know, the market that the banks ultimately are working with. Hopefully so far you've just sort of heard a little bit of flavour from each of the institutions around, you know, the markets they're in, the markets they're not in. I think it's very useful to get Charles's view as an operator in terms of what that means for him. I'd just perhaps like to open it up for the moment to the audience, see if there are any questions that people want to ask before we go on to the next stage of the panel. Anybody want to ask any questions at this point to the panel? I have a question here.
Why doesn't the financiers use models like it's in finance for supermarkets? Shopping centers get, for example, a certain fixed fee per square meter per year, a fixed rent, plus 8% of the returns. In the hospitality industry, that's not usual.
I would say that is a hybrid lease, with a fixed component and a variable component as a part of the turnover, and we do see that to a certain extent, and we finance that as well. What we as Ariel Bank, for example, don't do is we don't do fixed leases where we feel a little uncomfortable with the fact that it doesn't have enough transparency. In terms of how is the hotel really doing, because in a fixed lease you often don't even get the performance numbers of the hotels. But in terms of hybrid leases where you have an understanding of how is the hotel doing, we would certainly look at this, and we also see these structures. We do, I don't know about you, in between operators and owners.
We want to put a set of numbers to the bank that we can stand by. We look at free cash flow, obviously, that that can service that bank debt. But in order to work back for that position, there's a pretty kind of complex management model that sits there, which generates cash flows, balance sheets, P&Ls. So it's a living, breathing business, a hotel, and just looking at it in such kind of tight parameters, I think is probably missing the point of a hotel. The hotel, you need to look at obviously all of those different revenue centres and individually kind of go into a lot of detail in terms of the departmental operating profits in order to build the wall of decent bricks to build the wall to present to the bank, which is your free cash flow position. So they are from our perspective living, breathing businesses, and we reforecast on every 3 months. So we don't do these extended budgets for 12, 18 months out. Yes, there'll be a set of numbers that we stick to the bank, which is the underwriting numbers at the start of any sort of acquisition that we do. But it's about as soon as you get into any sort of hotel, 6 months in, you understand that business a hell of a lot better than you do when you're looking at purchasing it, because you've only got a limited amount of information. So they are subject to change the whole time.
I think that's part of the, I guess, fun of a credit assessing a hotel proposition, is that there are more levers for management to pull. So unlike some other industries, there really is the ability to influence that free cash flow by a number of different lines in the operating model and the P&L. So management has the ability to flex a number of things that can actually materially move those numbers. So I think it's slightly different to some sectors where it is the earnings are pretty much going to be what the earnings are because they're defined by X pounds or euro per square foot, versus a strong management team making the right decisions and flexing the model can actually materially move that positively and react in a downside scenario to mitigate sort of downside risk.
Any other questions at this point?
We've only had 4 people leave the room so far, so we're doing okay.
You're counting, Andy.
I'm writing names.
Okay, well, let's talk a little bit about sort of different classes of equity investor, and I suppose primarily I'm thinking about private equity involvement in transactions, and just be interesting to get some views around the panel as to, does a private equity investor give you comfort, or does it mean that the deal becomes less comfortable for you, maybe too stretched? Andy, do you want to start off with your views?
Quickly scanning the room to see who's here. I think it's a bigger picture than that. The answer is it depends who it is, because so we work with private equity, we work with family-owned businesses, we work with any investors across the spectrum, but we only work with investors who we consider have an appreciation and an expertise in the hotel sector. So if a private equity firm is looking at the sector and it's not a sector that they understand, I mean, we would be asking some questions as to sort of why is this investment attractive. I mean, a lot of our activity in the last 2 years has been with North American private equity, because they have been very active in the UK hotel sector, and they've actually been very positive for the UK hotel sector, because there are a number of regional portfolios that through the economic cycle and for various reasons had become a little bit unloved, a little bit of underinvested, and they saw value in that. So there was a number of North American private equity firms who were active, and we were lucky enough to work with a number of those, and we bought into the vision and the strategy, and they had fantastic expertise both on the acquisition front, and they really understood the nuts and bolts of how to operate hotels. So their asset management teams were very knowledgeable. So yes, we would work with private equity in those circumstances. But obviously you go into a transaction with private equity knowing that there is going to be a very clearly defined strategy at a point where they will ultimately exit some of those investments. They may reinvest in that asset class, but ultimately they are working to a defined strategy. Owner, operator, sort of family businesses will take very long-term views. So they might take investment decisions that are very different to private equity, but they can do so knowing that they are not going to sell this business ever. So I think it sounds a little bit cliche, but it's the right investor for the right asset, and that's not always easy to sort of. It's about marrying the right people.
Would you have a similar view?
Yes, absolutely. I can only repeat what you said before. I think key is not how long are you going to hold the hotel, because we can structure our financing around this and our expectations around this as well. I think key is really what is your interest in this asset class and what is your experience, because as we said, we want to be a lender that doesn't get cold feet in the downturn, and we also need to have a borrower that doesn't get cold feet in the downturn and knows exactly how to handle the asset class in the downturn. So I think that's key for us, and if it's private equity, it's private equity. If it's sovereign wealth, that's what it is. If it's mom and pop shops running the business, that's also fine, but it has to have some sort of sustainability within the strategy.
And I suppose the extension of that sort of question to you both is, does it matter what the exit is for you? Does it make any difference what the ultimate sort of end game is on exit in terms of how you're going to be repaid?
No, I think most business plans that you see, and it gives you some comfort, is that there's usually more than one exit plan. So there's usually a plan A, there's usually a plan B. I don't think it does, and often events will happen or circumstances will change such that the exit will probably happen at a different timeline and a slightly different way than the investors sort of painted at the initial outset. So no, I'm trying to think of a circumstance where I would be, or an exit strategy that was outlined to me that would not make me want to lend. I can't think of one.
Okay. Yeah, I would agree from our side, definitely.
And Mark, I mean, it's obviously early days for Metro, but I mean, if a transaction landed on your desk that was led by private equity, is that something that you would look at? Or?
Yeah, absolutely is the answer. But a reality is that private equity traditionally is not lent. It doesn't need borrowing at the levels that we have been lending at to date. And for us, it is a longevity of relationship that we're looking at. So, for the cold investment, then it's kind of not yet. And from the deal size perspective, it's probably not yet as well. So it's not a definite no, but it's just a reality check more than anything else that it's probably for a little while for us. Our total lending book for commercial side of things is only 1.6 billion. So, to take holds above 20 million is fairly risky, especially in view of the fact that we have listed this week.
Okay. And we've talked a little bit about sort of the banks that specialise in hotels versus those that don't, and those that may take a more of a sustainable earnings view, and those that may take more of a sort of a property loan to value view. I mean, I suppose question to Charles is, how do you feel about those different types of lenders, and how important is it for you? Because I mean, I think as bankers, we like to think that actually, because we understand the hotel market, that's a value to our customers. But I mean, is it a value to you as an owner?
Yeah, I mean, the short answer is obviously. I mean, you don't kind of waste your time educating everybody about every single hotel deal. You want to work with people who just get it, and having a relationship manager who gets it instinctively in terms of understanding where you're coming from and what you're going to try and do with the hotel, just it saves a huge amount of time and effort, frankly. So it's a laziness piece really more than anything else. I just can't be bothered to explain it. But we have a really good relationship. We try and give the bank as many answers or answers to questions that we know that they're going to ask before they ask them. So when they get to that credit paper, they've got all the information there, the numbers have been presented, it's been sensitized down, there is a strategy, there is an exit broadly, there is a structure which we know that they are happy with. So it's kind of going forward and understanding what they're going to ask, how they're going to ask it, why they're asking those questions, and providing that information, the answers to that at the outset, as opposed to waiting for those inevitable questions to come. So, yeah, I mean, relationship is everything, so far, I mean, that's been one of the key. It's a key component of success, which is people, you can pick up the phone and have that conversation very quickly, as opposed to doing the whole presentation, sit down. This is, some deals work too quickly. Some deals you need to move much, much quicker than that, and having the ability to do so, the hard work has been put into already, because you've invested in that relationship over the course of the last, it's not just 3 years, but some of those, some of the guys within the hotel lending teams that I work with, I've known for 10 years. So they get it, and that's just a huge time saver.
They're sensitising your numbers after you've sensitised
Undoubtedly, them. Yes, undoubtedly. But I mean, we know that they're going to do that as well. So we put a base case like any bank would, and sensitise up and down from there, and look at the risk factors, provide answers to questions, that doesn't take away from the job that they do. Obviously, they need to be seen to be running the rule over anything that they get before they take it to credit, but it's making their job easier, and hopefully making their job easier gives us the result and the answer that we want.
And that is encouraging to hear from a lender that sort of plays on we're a relationship lender, we're through the cycle. I guess I'm not sure every borrower sort of adopts that approach, because I think it must be hugely tempting for a borrower if I show some terms and it's X amount of leverage, but somebody else maybe who hasn't been in the sector for so long but comes in with an additional turn of leverage. What tangible value do you place on that relationship piece? Because the read through from someone providing an extra turn of debt is there's a smaller equity check to be written. So it must be hugely tempting for borrowers to consider some of these structures. And I guess time will tell how that all washes through the cycle and business plans that don't necessarily play out. But it's a real challenge, and I see it quite a lot. And it doesn't always fall in my favour.
Yeah, no, I mean, it is tempting. I mean, you got 2 or 3 people saying, yeah, we want to do these deals on these terms, and you get someone coming along and giving you X amount more. But the key thing on that is timing and the ability to be able to deliver on that. I mean, when we've got, there's always the temptation to go with someone else that says, all right, well, we can lend 7 times earnings, and you go, brilliant, because it makes the deal even better. But actually, you don't know that process is going to be any easier, because actually they might say, well, credit committee or approval to credit committee is 3 weeks. You know from your existing lender, approval to credit committee is 3 weeks. So when they say we can do it at that level, absolutely, let's do it. We've had a couple of occasions where you are, I guess, tempted, and you do it, and it comes back to bite you, and you go, not doing that again. So that's just all part of the learning process. But yeah.
And I suppose there's also a facet that says that just because a bank will lend you that amount of leverage doesn't necessarily mean you should take it, because how much pressure are you potentially storing up for the future? Because actually you've still got to meet the repayment schedule on that, and you've got to generate the cash. So
and also the covenants come in as well. The actual debt quantum might be there, but then when you compare the covenant suite, when the detailed term sheet comes through, you've signed a deal, or you've expended so much time getting to a position where you don't have an alternative, and suddenly you're working with a set of covenants which are an absolute killer, and you're making the same mistakes other people have made historically, which is too much debt on hotels which can only afford to pay a certain level. So we want to learn from those mistakes and not do the same thing.
And that is why I guess it's ultimately an element of art rather than pure science, because for a lender into the sector, you're trying to land on this strip of land that sits in between. You've lent too much, you've over-leveraged business, therefore you're part of the problem. You're not lending enough, you're stifling growth. And so you need to find sort of terms that sit in that strip of land that sits comfortably in between the two. And that's difficult, because there is periods in the market, and now would be one of those times where liquidity is so strong that terms, pricing, structures and everything is being dragged into the territory where maybe we've been historically in the sector, and there's been some casualties in that space because businesses haven't been able to sustain the level of borrowing. So that's why I come back to the sort of starting point from our assessment is genuinely understanding what's the motivation of the borrower, and sometimes if the motivation is just I want to leverage this business to the absolute maximum the market can take, that might not necessarily be the right outcome. That doesn't mean they won't go down that path, but that's probably not what we're going to be doing.
No, and I think we've still got to recognise the fact that we're in a low interest rate environment, and typically, when you're perhaps heading towards the top of an economy, which some elements of this market feel like we are, you're normally in a slightly higher interest rate environment. So that there is an expectation that interest rates will rise, and potentially that adds to the cash flow challenge. Did I see another question? Yes.
Generally, I ask because it's about innovative financing, and so. Aren't there a lot of models on the market in Great Britain or so where tax advantages are used? For example, in Germany there's a lot of this tax advantage of writing, but also in Great Britain you have this special condition of people who are resident without domicile. They are foreigners living in Britain, and in fact for some years, up to 17 years, they are tax-free for income arising outside Britain. So it would be natural to get a company outside Britain, make a participating loan to somewhere. The borrower can deduct not only the interest but also part of the profit from tax that goes there, and the lender has it tax-free, and then the lender gives kind of, instead of getting it back, the borrower buys back some part of his loan in paper and has in the future tax-free his own profits. So such models are used in other countries. And here in the major European countries, it's not usual. So I wonder why.
Well, I think there's certainly an element. I might ask Andy to comment on this one in particular, but I think there's certainly an element in there. If you look at the ownership structure of some of the banks in the UK, that would want to be sort of very careful about how their interactions around tax will be viewed by potentially their largest shareholder. But Andy, do you want to comment on that one?
You might ask me to answer the question. I may decline to answer it. I think, unfortunately, I'm not going to try and construct an answer, because I don't sort of know that. I think the question you're asking goes beyond hotel sector appetite. I think there are incentives within the UK, and I'm sure in other markets, where there is a desire for regeneration, and there are schemes that hotel borrowers can buy into that does give them some advantage and contribution because they're part of a broader regeneration scheme. But I'm not sure is the answer around sort of why there aren't sort of tax incentives as you just outlined. And I think that is actually not something that we see. And it's not a question that I'm sort of faced with. Obviously, tax is part of an overall investment strategy, but not around the angle that you're coming from there.
And I think typically that it's not incumbent on the banks to sort of come up with those schemes. It's incumbent on the banks to look at what the requests are from their borrowers, and then see if that's feasible to do within, from a structuring perspective and from a legal and tax perspective. Any other questions from the floor at this point? Yeah.
Paul Shield from John Ryan Partners, we're property construction consultants. We've noticed in some other sectors, notably residential, the introduction of crowdfunding for companies like Lakesess and the like, which is starting to pick up on that debt market or loan market. Have you noticed that at all in hospitality?
I suppose I'll comment briefly on that first. In my role as head of leisure, I look at other classes other than hotels, and the one that we do see it quite prevalent in is in the restaurant market, in the startup restaurant market. I think when it comes to crowdfunding, that sort of peer-to-peer funding, there's got to be a certain level of understanding. So those schemes that work well for crowdfunding tend to be those that there's some sort of recognition by the people that are buying into them of what the product is and how it works. So things like restaurants are very easy and transparent to understand. I think the thing that makes restaurants probably more appealing for that market than hotels is just the capital investment required. Single site restaurant can be opening for something like 500,000 to £1 million, whereas hotels obviously we're looking at considerably more. But anyone else on the panel want to add to that?
Yeah, it's crowdfunding in that kind of tech space and startup space. I mean, you see that, and you see that. It's just I think it's the amount of capital required, because any sort of hotel that's worth its salt is going to be millions, and so crowdfunding millions is, that's a big crowd to deal with, and that's a lot of investors to have to report back to. It's one of the challenges that we've got, and the structures that we have at the moment, which is just the high net worths that we deal with, having to keep them abreast of what we're doing, when we're doing it, why we're doing it, takes up a huge amount of our time. And frankly, it's you kind of say to yourself, you want to work with bigger funders, bigger institutions, bigger family offices that don't require that level of hand-holding. So the idea of going out to a large crowd and each one of them investing £25,000 into a £5 million hotel, that just sounds like a nightmare to me. But
did you say you've seen some examples in the resi?
Yeah, I guess so I'm thinking of coming in RateSetter as an example. So I've seen some examples with that, but it's RateSetter who source the money via the crowd, via their platform, and then RateSetter become the loan to the asset.
Yeah.
So I'm trying to think of the other name now.
I think it's a fascinating space, and it's really interesting to sort of I've never seen crowdfunding in competition, anything that I've been looking at, and I think for the reasons that have been covered there. But you sort of think about it, private equity is very active in the space, and in many ways, there's a set of investors behind, the private equity funds. It's a different animal, but you could say it's not that different.
It's still very small. It may evolve. So I think lending to the hospitality sector in the UK is something like £30 billion, but I think crowdfunding to that sector is probably less than 250 million, 300 million at this point. I suppose the only other point is sometimes people buy into these schemes because they see they're getting some sort of discount. So I think Brewdog is an example that I've seen where people buy into that because they get, I don't know what the discount is, but they might get 20% off every time they buy a pint in one of those pubs. And people can identify that. And whereas I don't think people interact with hotel products often enough in a single location to make that sort of discount concept worthwhile.
I wondered if it was the driver was where if they have any, if somebody's got £50,000, £10,000 right now, it's difficult to make that money work for you anywhere, and you could, sort of mainstream bank interest rates, they're not going to get any much of a return for that, and with inflation probably negative. So the appetite for risk is probably a bit more, and I know those crowdfunding platforms are exponential growth at the moment. I just wondered if it started eking into the hospitality industry yet.
I think where it might work, I guess where it might work is if you had something that was really, really niche and you're trying to get some sort of new concept that maybe not be hotel asset investment, but it's sort of product or service or something around the space, and maybe it's not, you're not, there isn't such a history that it's very easy to obtain traditional forms of finance. That probably lends itself to it's that type of product, but not yet. But maybe it's a topic for future conferences, because at some point there will be a transaction, I'm sure, in the sector. Probably a reasonably small one to start, but we'll watch this space.
You want to watch. Any other questions? Well, just to close with a couple of thoughts. I mean, one of the questions I wanted to ask was around bank appetite for new concepts or new brands. So, whether that's a new brand being bought out by one of the major brand houses, or whether that's sort of a completely new concept. How would you feel about lending in that scenario? What are the sort of thought processes that each bank would look at? Andy, do you want to maybe start with that one?
So, I mean, the short answer is we would, and we are funding situations like that. So, without getting into specifics, I am currently funding a development in a non-traditional hotel market in the UK for a brand where it's their entry point into the market. So we are doing that. Is there more thought process and rigour around a lending assessment or something like that? Yes, because any advance that we make, we clearly want to understand how this is going to work, and that the lend that we're making ultimately is a credible lend. So I think and we have to be part of that, because there is so much innovation going on in the sector at the moment that if we were not lending to new concepts or evolving brands, then we wouldn't be doing much business, because all of the brands are doing something different across their product suite, because I think the market's dictating that different types of users of hotel products want a different experience. So one core brand is not working anymore. So if we're not lending into some of the new concepts, then we're not writing any business. So thankfully we are.
Okay. Bettina?
I think for us it's the same thing. We have lent to, I think one of the key questions, and I think that only relates to the work that's involved in assessing the situation, is are we talking about a new brand that's a brand of one of the big operators and comes with a significant reservation system? I think that's a little bit of an easier sell. Another thing is, are we really looking at a completely new hotel operator with one single new brand? And that's more difficult, but we have done it before, and we, for example, we were the first lenders on the Citizen M's, and when they first opened in Amsterdam. And did we have to do a lot of selling internally and jump a lot of loops? Yes, we did, but we got there. And I mean, if you know the Citizen M concept, it's a concept where actually we're not even talking about real structural building. We're talking about containers being stacked on each other. I mean, there the question really is, what's the sustainability of the building and the real estate as such? But we got our head around it, and so today we're happy to see this as a growing hotel concept. But it is more difficult, and I think if you were to somebody who's looking for funding for a new hotel concept, you really need to do a lot of work and a lot of presentations to the banks to get them started.
Yeah, and I suppose the key question that the banker's going to have in their mind is sort of what does that concept mean to the general public? Is it going to resonate, and is that going to drive the occupancy and allow them to achieve the rates? But finally, Mark, on that question, any thoughts?
Yeah, again, is down to management. So a little bit similar to what Andy was saying. Recently funded a completely non-branded country hotel, but the management behind it own a couple of iconic brands and intend to leverage those two brands to put into the country hotel. But the guy grew up in the area, has lived there for 20 years and has gone for drinks and stayed at the hotel and done his research over a long, long period. And so therefore, the due diligence that we were doing as we were speaking to him was that he really understood the local market and understood how to leverage the iconic brands that he's got to do that. And then the flip side is the new brands that Bettina was talking about, that the big companies are launching, in lots of respects to combat the Citizen M's, But what comes with those are the booking systems. So therefore they're driving the occupancy straight away. So the answer is yes, we would lend to new concepts, and we are lending to new concepts already, albeit at a relatively small level compared to other people on the panel.
Okay. Well, hopefully that's given you sort of a sense of the broader banking market outside just the traditional high street banks, and which lenders are in which markets, and potentially what their deal structures will look like. I'm very, very conscious that at 5:30, and the five of us sort of probably sitting directly between you and some drinks at the bar. So unless there are any final burning questions, I'll probably bring the panel to a close at this point. Thank you for your attendance, and if you'd just like to join me in thanking the panel, be very appreciated. Thank you.